If you're an experienced investor, you know that dividends are an amazing way to earn some sweet passive income. Dividend ETFs offer you fantastic exposure to the highest yielding dividend stocks on the market. But hold up, don't get too carried away with those juicy high yield dividends just yet. Behind the mask of passive income, there could be some sneaky risks you need to watch out for. Today, we're pulling back the curtain on the Schwab US Dividend Equity ETF ticker SCHD and revealing why this dividend ETF could be a trap for unsuspecting investors. So what's the deal with SCHD? The Schwab US Dividend Equity ETF is an exchange-traded fund managed by Charles Schwab. Its mission is to closely track the performance of the Dow Jones US Dividend 100 Index. This means that SCHD is comprised of the top 100 high-yield dividend stocks on the Dow Jones. These companies are spread across various industries like tech, energy, and finance, offering investors a well-rounded portfolio. The stocks that form part of this ETF are selected based on their high dividend yields, debt levels, cash flow, and dividend growth. Some investors consider it the ultimate retirement ETF because of its impressive roster of high-yield dividends. Another attractive feature of SCHD is its low expense ratio and 3.72% dividend yield. When it comes to ETF investing, expense fees can quickly eat into your returns. That's why it's critical to select an ETF with reasonable fees. SCHD has an expense ratio of 0.06%, meaning if you were to invest $10,000 into the fund, your expense fees will only be $6. Aside from providing a great dividend yield, SCHD is also a good candidate for long-term growth. Over the last 5 years, SCHD has outperformed the S&P 500 with a total return of 72.9%, compared to the S&P 500's 57.45%. Sounds too good to be true, doesn't it? But it is. Is there more to SCHD than meets the eye? Could SCHD be a dividend trap for investors? Let's dig in and find out. In a nutshell, a dividend or yield trap occurs when a company offers dividends it can't sustain. If a company can't afford to pay, it will cut its dividends, causing its stock price to plummet. This means that an investor will be left with assets worth less than their initial investment. Think of it like this. Some deals are just too good to be true. For instance, if you're trying to buy an item with a massive discount, you might start to question why the price is so low. The same goes for dividends. Investors are lured in with high dividend yields, only to discover later on that the company doesn't have the value its dividend promises. Now that you're familiar with dividend traps, it's time to take a closer look at SCHD and find out if this retirement fund is too good to be true. Recently, Investors Observer published an article claiming that the SCHD ETF was harboring toxic firms that could slash dividends, and they might be onto something. This year alone, the $45 billion ETF has already dropped 10% due to some of the stocks in its portfolio. SCHD tries to balance its portfolio to spread risk evenly among various companies and sectors. The fund regularly sifts through stocks to ensure it's invested in the best dividend stocks as the market shifts. Recently, it swapped out 25% of its portfolio in response to the crisis in the financial sector. But even after the swap, it seems SCHD might be holding onto some questionable positions. You see, the current banking crisis is closely tied to the regional banks that have been failing, and SCHD has a concentration of these banks in its portfolio. For instance, First Republic Bank crashed recently, sparking fears that other banks like PacWest and Western Alliance would follow suit. This raises concerns for SCHD's portfolio, which includes Comerica and Zions, two banks analysts suspect may collapse soon. But it doesn't end there. Even the banks that survive will likely have to lower their dividends to match the actual value of the stock. And it's not just SCHD's financial sector that investors should be wary of. The fund is also invested in Paramount Global. Paramount recently slashed its dividend price, causing a 25% dip in its stock price. This is a problem for SCHD, as investors keep SCHD in their portfolio for its dividend rewards. And there's more. SCHD's energy positions in Valero Energy and Chevron may cause some worry, as these companies are expected to bring in lower returns due to falling oil and gas prices. What does this mean for SCHD? Well, depending on your perspective, there might not be too much to worry about with everyone's favorite ETF. Yes, some holdings are currently struggling and may cut their dividends, but as we mentioned earlier, this is a well-diversified fund covering other sectors, including healthcare, communications, and tech. Its position in the final sector makes up 14% of its portfolio. But the financial sector is also well-diversified, covering not only banks, but insurance and other finance firms. In fact, the potentially toxic companies make up less than 1% of its overall portfolio. This means that even if their dividends are slashed as expected, it may not have a significant impact on the entire fund. There may be some cause for concern in the energy sector, as energy makes up 9% of holdings, and an energy crisis will cause some movement in the ETF. How to avoid dividend traps. Now that you're probably wondering how to avoid dividend traps like this in the future, and we have the answer right here. When choosing a dividend stock, don't focus solely on the yield. That's where dividend traps catch many investors. Here's a particular example of why looking at a dividend yield is a bad idea. For instance, if Coca-Cola was offering a $1 annual dividend payout with a current stock price of $20, its dividend yield would be 5%. If this stock price drops to $10, its new dividend yield will be 10%, and investors may buy in without realizing the underlying issues. So don't get swept away by high dividend yields. If a stock's dividend yield is high due to poor fundamentals, it'll mean a fall in the dividend price down the road. You should also pay close attention to the payout ratio. A payout ratio is the percentage of a company's earnings that it pays out in dividends. Imagine if a company had a payout ratio of 100%. That definitely wouldn't bode well for the company. While there may not be a universally accepted payout ratio, most companies report payout ratios between 30 and 50%. If a company has a payout ratio above that, it may not be investing enough funds into itself, and if it's below, it may signal an increase in dividends down the line. Finally, always keep an eye out for solid fundamentals before buying any dividend stock. So now you're equipped to avoid dividend traps. You're well on your way to building a successful investment portfolio. And don't forget, knowledge is power. So stay informed and make smart moves to let your money work for you. Happy investing, and catch you in the next video, where we'll dive into more amazing investment tips and strategies. Until then, take care. If you've enjoyed this video, be sure to smash that like button, subscribe, and comment with some of your thoughts.